There we go. So I really just want to have a chat generally about the rate environment, right? So everybody, just to kind of have a macro understanding of why rates are going up, it's curve inflation, obviously, right? Fixed rates rising very, very fast, variables now catching up to it, right? From how fast they're both growing together. So if you look at variable a year ago, a little over a year ago, we were at 1.21, 1.25 and around there, extremely low rates. Fixed was right around probably 1.65. Not a huge difference in the two, and I'll show you kind of the difference now that we have moving forward. What we're going to be seeing is variable rates. Our forecast from what we're hearing, like I said, don't take it in stone, but is to increase by about 100 basis points by the end of 2022, and potentially another 75 increase in 2023, right? So if you look at rate now, the prime rate is 3.7 for variable, okay? So we're probably going to see that go to potentially 4.7. Right, so the Bank of Canada, right, they set the prime lending rate. So their next increase is going to be when they're meeting on July 13th. Probably going to be probably 50, max 75 points they're going to take. And the big thing that this affects for us on variable is how we qualify clients. I'm going to show you guys a few examples on the next few slides. But like I said, right now we're 3.7. It's probably going to go to 4.2 or 4.45 on July 13th. Okay, so if you have a variable rate mortgage, what you're always locked into with a lender is prime minus whatever it might be. For easy math, it's prime minus 0.5. As of right now, rates are 3.7, so you'd be 3.7 minus 0.5, so your rate's going to be 3.2, right? If prime goes to 4.2, you're going to be 50 points off that, so now your rate's going to 3.7. Okay, now with us, every lender's a little bit different, but with us, your payment actually doesn't change. So as rates go up in a variable, your payment will remain the same. There are a few lenders out there that as rates do go up, your payment's going to go up with it. But with us, essentially your payment remains the same. More of the payment is going to be going towards interest than going, right? Therefore extending out your amortization a little bit, right? So what a lot of clients might do, or what I say to them is, okay, if rates are going up, prime's going up, if you want to keep your amortization whole, then simply all you have to do is just increase payments by roughly about 10%, if that's something that you can do, right? So taking advantage of the prepayments. If we go to the next, any questions on that? It's kind of where we see variable going. Now, if you look at fixed as well, fixed, we've probably gone up 10 points every month in the last or every week, sorry, in the last 6 months. It's absolutely crazy. Like right now, we're roughly about 5.04. So variable is, variable right now, you're probably going to be prime minus 0.6, so 3.1. So it's almost 2 full points in the swing between variable and fixed. A little over last year, about 13 months ago, there was only about 0.3 to 0.4 points in the difference. So now going into the qualifying rate. So the way we qualify clients, this is the big thing, okay? So it's same as all lenders. The higher of the Bank of Canada posted rate of 5.25, or client rate of +2. So if we looked at, let's say a year ago, the client rate was 2%, for example, or 1.7%, that +2 is 3.7%. So we're still going to use 5.25 because 5.25 is higher than the 3.7. But now if you look at a client rate of 5.04, we have to add 2 to that. So a client is actually qualifying on 7.04 versus the 5.25, which they were qualifying a year ago on. Right? So that makes a large difference. Like I said, I have examples to show you exactly how that does change the purchasing power. But one thing, let's say you have a client that's a little bit close on debt servicing, okay? We can offer the 5-year closed variable mortgage, and I can still use that today 5.25%, the Bank of Canada qualifying rate. Because if you look at prime right now, let's say it's 3.7 is prime, as I mentioned, right? As of right now, I have prime minus 0.71. So that gives you a client rate of 2.99. Right? So 2.99 plus 2%, you're at 4.99, still below the 5.25. So you're going to qualify off 5.25, right? But if we do the fixed, we're going to be 7.04. And that's a large difference. And I'll show you how it's going to affect your purchasing power on a couple slides from now. So any questions on how we qualify? Okay, so it's always client rate plus 2 right now until, if rates do decrease, and whenever that may be, if it goes below the 5.25, then we can use that. So I always say, the benefits of getting pre-approved now, it's so important as rates continue to go up, like I said earlier, almost
Record to
JW's
loud.
loud. There you
There
go.
you go.
Yeah, I didn't touch anything. I've just been letting people in, so I'm not sure what happened there.
Bottom line, we're back.
Sorry.
So just to touch on the benefits of getting pre-approved, as you guys know, but even then, as one of you guys mentioned earlier, offer being stronger, submitted with an approval letter, right? We're always going to submit, we're always going to give an approval letter to a client after we have an official approval, because all the work is being done up front. Like the biggest issues a lot of times with financing is income. It could be credit that we have to mitigate. So we can do all of that stuff in advance. If you give me a person's sale on Monday, I can have it approved on Tuesday. Right? If it's default insured, if there's an appraisal required, you guys know appraisals are taking a little bit longer than we want right now. They used to be 3 or 4 days. Now they seem to be sometimes a week to 10 days, right? So I can get an approval within 24 hours subject to appraisal. And hopefully that appraisal is hopefully they get a little bit better than they have. And I found, I don't know if you guys have, but they've been a little bit longer in the last month than what they have been previously. So it's a bit of a frustration on our end.
Try being us, and we're all being put under short condition dates. And
Oh, exactly, right? So, and especially in this market with changing rates and how we qualify them, it's knowing what they can afford, right? Because some of them may be a little surprised that they might not be, they might have gotten a pre-approval, let's say last year, and I'll show you in the next slide how it changed, how the qualifying rate has changed, what they can be approved for. But they might have said, oh, I'm 500 grand last year. I'm deciding to buy again. I'm going to hold the rate and it should be 500. Well, that's not going to be the case now. You're not going to be 500.
Yeah.
Well, if you look at the qualifying rate, so if you look at the far left column on the pink, that is like when fixed was about a year ago, right? So fixed at 1.5 or 1.9, right? So if you go back to the math I said earlier, we have to add 2, right? So the qualifying rate is going to be essentially 5.25, because 5.25, the Bank of Canada qualifying rate, is higher than the client rate plus 2, right? Because 1.9 plus 2, you're going to be 3.9, right? So if you look at the middle column now, right? That's the fixed rate of 5.04. So we have to add 2. So the interest rate now you'll see is 7.04 versus 5.25. So if you look at the numbers there on the bottom of the pink one, the qualifying number we have to use 2,943 for our debt servicing. It goes up almost $500 when we put that rate from 5.25 to 7.04. Right. And as I mentioned earlier, we still qualify the client on the variable based on variable rates as of today. I can use that 5.25 again. So I've had clients that, for example, I've received a live deal and there hasn't been a pre-approval put in place and I've approved them on variable and not on fixed. And a little bit of a workaround is on that. If we approve them on the variable, they can actually flip into a fixed after their first payment at no cost. Right. So they can still get into that fix if that's what they really want, but we can do the variable to approve them. Okay. So I'll explain this a little bit more on how it affects purchasing power on the next slide. But to see how big of a difference that is, because when we look at for debt servicing, there's 2 different numbers. There's TDS, which is total debt servicing, which is everything from property tax to heat to the principal and interest payment at the qualifying rate to student loans, car payments, everything. The big one for us is GDS. So what GDS is just the home expenses. So that's your heat. We have to use $100, property tax, whatever that might be. And then also what your principal and interest payment is based on the qualifying rate, right? So I need to get my GDS below 39%, right? So that, if you look at column 2, that additional $500, that really is going to affect that purchasing power if we do the client rate plus 2, which is 7.04. Right?
You have a question. Jillian has a question for you, Mike.
Yeah.
You unmute yourself, Jillian?
Hey, Mike. Just wondering, when you have someone that works with the variable rate and you say they can flip to the fixed after their first payment, what changes happen to their rate then?
So it's going to be, great question. So it's going to be whatever the rate is at that time, right? So I can't backdate back to a previous rate. So let's say rates change 10 to 20 points from the time of we got the variable approved to after their first payment, and they want to flip into a fixed. They won't be able to go back to that rate 20 points ago. So let's say I have 504 right now. It might be 524 after their first payment, right? So, but and if they do really want to fix, their payment is going to jump fairly substantially because they're going to have, like I said, 3.1% or 3% roughly on variable. Now their payments can jump up to 5.24, right? So that payment, they are going to see a fairly significant payment increase from what they originally signed on the dotted line, essentially at the lawyers and at the bank a month ago, because that rate is going to be much higher. But it's just
So would
essentially,
it technically, sorry, go ahead. I
essentially,
was just
it's-
wondering if it would, sorry, there's a delay. I'm just wondering, would the rate just be the same as if they had signed up for the fixed to begin with?
no, it'd be slightly higher, because all I can do is when they
Right.
decide they lock in, it's going to be whatever the rates are at that time. So in a perfect, world, the rates haven't changed from when essentially closing day to when their next payment is. But as I said earlier, it's almost like it's 5 to 10 points every week. So I can, based on how the rate's been going, almost with some certainty, that I would say the rates will be ever so slightly higher when they go to lock into that fix versus what it would have been day of closing.
Got it. Thank you.
No problem. So how does this affect the purchasing power? So I have a couple different examples here for you guys. So situation, let's do easy math on this one. $500,000 purchase, client has 5% down, and let's say household income is 108,000 between both buyers or single buyer, whoever it is. So the mortgage, including CMHC fees, is 494,000. Okay, so at $108,000 of income on a $500,000 purchase, so mortgage is 494. My GDS, which what I told you guys, remember, that's just your housing costs, so your property tax, your heat, and then the qualifying payment on the principal and interest is 38.3%. Okay, using my 5-year fixed example, my GDS is now 44.1%. Right, so quite a difference in a jump there. So if you remember, I said my GDS needs to be below 39%, and that's on, especially on a default insured deal, so less than 20% down. That's a hard line in the sand for CMHC or Sagen. So it does make a difference. It's just showing you that I can get a variable done and have the debt servicing in line, or their debt servicing in line would have been in line a year ago using the previous rates, right? But now we're client rate +2. It's really jumped up that debt servicing, and that's assuming there's no other debt. Salary stays the same. It just shows you the impact of the qualifying rate, right? So to kind of put it into income terms for clients, if they want to go on the fixed rate, right, the 5.04, so we have to qualify them on 7.04. I would need their income to increase from 108,000 to 124,000, right? So an increase of $16,000 per year, just to get that 44.1 back to 38.3, right? So a lot of times for debt servicing, right, that's a lot of times it's either debt servicing or credit for the most part is what we have to mitigate on the mortgage side, right? So for debt servicing, right, it's either we increase the income, a lot of times that may not be able to happen, or we decrease the liabilities. Right, those are the only two levers we really have for debt servicing. So if we want to decrease the liabilities for GDS, there's only property tax. The heat has to stay the same, so we'd have to reduce their purchase price, right? Because property tax usually goes slightly hand in hand with purchase price. And then so it's quite a big difference in what the clients can actually purchase. And if you look at like qualifying example number 2, the next one, Maureen.
Oh, sorry.
Yeah, no problem. So let's say going back to the $108,000 same income. Okay, so they were approved for 494 at 5.25. Now using 7.04, they're qualified for 425 mortgage. So that's quite a difference if you're looking at 494 to 425, right? So that's really going to affect, as you guys know, anywhere from different neighborhoods to quantity of bedrooms or bathrooms in a client's home. Like it's not going from 494 to 475. Like it is quite a large shift. And that will only continue to increase as rates go up. And if clients want a fixed rate, right, it's going to continue to make that gap wider, right? So it's pretty substantial. So, but as I mentioned, if they still really want that $494,000 mortgage, which is $500,000 purchase price, I can do that on a 5-year closed variable, okay? Because I can still go by the 5.25, right? But as I mentioned, July 13th, when we see the prime rate increase by about 50 points, right? Now you're going to be 3.7. So it's going to be prime's going to be 4.2, right? 4.2 minus 0.7. The client rate's probably going to be 3.5. Now we're going to do 3.5 plus 2. So we're going to qualify off 5.5 because 5.5 is larger than 5.25. So now we're going to, by July 13th, we're going to start getting into that variable shift. It's going to be still better than fixed to qualify, but It's now variable. You're going to see start to creep over the Bank of Canada qualifying rate. Make sense? So that's kind of where we're, so bottom line, kind of sum it all up here is obviously fixed rates have been increasing very steadily. Variable rates are going to continue to increase. Next rate increase is going to be July 13th when Bank of Canada meets. You'll hear it on the news, whether it's 50 or 75 points. But it's so important for your clients to get pre-approved right now to get at that lower rate to increase their purchasing power is the big piece here. And variable is fairly attractive right now in my mind. I mean, because there's such a spread, as I mentioned, between the two, almost 2 points right now. A little over a year ago, there was barely a spread in the two, and a lot of people were going fixed because you're locking in 5-year fixed under 2%, which is amazing. But now, you mean 5.04, probably going to 5.14 in the next week doesn't quite seem as attractive. So you're seeing a lot more people look at variable and loving the flexibility that they can get into a fixed from there if they want to, but they don't have to requalify, simply just signing on the dotted line. We just send them a document to sign. And kind of, I mean, where rates are going to stop, and we don't fully know. Like, we're probably hearing close to 6% in a year on a 5-year fixed, right? And as I mentioned on the second slide, but you guys are going to have this, will all be emailed out to you guys, is probably 175 points above what we are right now. So 3.7 to probably 4.45, as I mentioned, is where we'll see rates go to. So just yeah, it's definitely increasing. It's been over the last year, it hasn't stopped, but and we don't see it stopping in the next year or so. So just want to really hop on, guys, and I can answer any questions you guys have about rates or any other financing questions at all. Please let me know. But I just want to really show you guys how it does affect your client's purchasing power, and especially a client you may have been dealing with a year ago that thinks they're still good for a certain number. They may want to really get that checked out again because it's probably changed for them.
Mike, why down payment, Nova Scotia Down Payment Assistance Program, will they not do it for mobile homes?
So that's essentially a CMHC decision, right? Because a mobile home, are you talking in a park?
Yep.
Okay. So in a park, you could put essentially 80% down, right? Normally the general rule is you put 20% down, you avoid CMHC, right? Mm-hmm. On a mobile park, on leased land, you cannot avoid CMHC, okay? So it doesn't matter what your down payment is. So CMHC's rule, and until they change it, they will not do a borrowed down payment. So this is still qualified as a borrowed down payment.
Okay.
Okay. So that's not essentially, it's not an us rule, or it's 100% CMHC's call until they allow a borrowed down payment. And maybe they'll do an exception on using this program. I'm not sure, but yeah. And I just wanted to put this up here for you guys, and you guys have heard a lot about this. It just really makes it relevant again, right? Getting up to that purchase price of 500 in HRM, up from 300. I mean, I haven't done one of those applications in the last year and a half using this program. But now, especially increasing the income from 75 to 145, and then also increasing the purchasing power up to 500, I do believe it makes it a little more relevant than it was previously. So I don't know if you guys have had a little bit more client interest in this product since it's been updated over the last week, but I think
this is a great opportunity, Mike, and it's good to get together with different vendors as well to check things out. My question was the same as Maureen's, is that, I mean, I guess it goes deeper than this, where we went from trailers to mini homes to, they're getting a totally different reputation. It's almost like the market needs to catch up, right? To say, because that's the way of the future, like, and that's what people can afford. Yeah, we need to have that. So I think it goes deeper than this, CMHC to say, how are we going to accommodate this? Is probably part of the affordable housing situation. So interesting, because I have
I'll send an email out to my the client rep, Steve Van Held at CMHC, and just see if that is on the table. And I'll just send a note to.
That's Vicky. Awesome. Thanks.
Yeah. No problem. I'll email Steve on that this morning.
Yeah, because something's going to happen because people's buying power have dropped, and where it has, this is going to be, and there's some beautiful ones out there.
Oh, for sure. For sure. So many clients that qualify for this that have great credit. I mean, they're meeting all the criteria. I mean, you're seeing mobiles now, as you guys know, 250, 2.25. I mean, not everybody has that $12,000 plus closing costs, right? You know,
Yeah.
I agree with you. I don't know why they're not doing it, but they do need to catch up, and I'll have an update there from Steve, and hopefully he can give us an answer on that. Perfect world, it's coming soon, but we'll see. We'll see what he said. Yeah.
So did anyone have any questions?
Any questions about rates or anything, kind of where things are going or what we went through here today, or could be a specific financing question you guys might have on the deal that you're working on that's totally unrelated to what we're chatting about now? Happy to answer any questions.
Mike, if you had a crystal ball, and I know you don't, what do you think we're going to be looking at like 2 or 3 years down the road? Do you think? I don't know. It's hard
They
to
own,
say, I know.
our economists only give us about a year out, right? We're
Yep.
probably going to 6%, as I mentioned on the fixed. They did say probably halfway into 2023, as I mentioned on the variable, about 175 points. Looking at 2 to 3 years out, I do things start to slow down, normalize a little bit. I think the days 1.5, 2, 2.5, 2.25% are gone.
Mhm.
Next 2 to 3 year time frame, Vicky, that you mentioned. Maybe in 2 to 3 years, could they slip back below 5% a little bit? Yep, they could.
Yep.
But I think you're going to see 6 before you're going to see sub 5 on a 5-year fix.
Yeah. So this is kind of our new normal, and we're just going to have to get used to it. Yeah.
Exactly. Yeah. Right. So it's really affecting how much clients can purchase. That's the big thing, which is going to cool down the market a little bit, bring house prices down. Good. Starting to see a little bit now, right? So.
Yep.
Yeah.
Yeah. But when I bought my first home in like 1990, it was a lot worse, but the house was a lot cheaper.
Yeah.
Yeah.
Yeah, exactly. Right. And back then they didn't have the stress test, right? So this all revolves around the stress that was brought up like 4 years ago.
Mhm.
Right. So it's all part of that. But now the stress test is really starting to have some stress. It's really starting to people, right? Because if you see, so going back to our easier math there earlier, Vicky, like if you look at 6% rate, now we're qualifying client on 8%. So that 405, so it went from 494,000 down to 425. Now that could go to 376, right? As that rate goes up. So that's, that's over $100,000, $120,000 in 2 years, give or take, on what a client can afford, assuming income. So huge impact.
Yeah.
Yeah.
It may have a huge impact too for those that own an expensive house now when they go to renew.
Yeah, exactly. And what we're seeing now to clients, and the clients know this, but if they're selling their place, have a chat with them about porting their mortgage, because chances are the rate that they have currently when they're selling their home is going to be lower than what they have right now.
Mhm.
Right. So I'm doing more ports than I ever have. And a port is just simply porting the rate over to the new home, and therefore there's no penalty. Right now, what we do a lot of times is people will be buying a larger home, need a larger mortgage. So we'll do what's called a blended rate. So let's say they have 3 years left on their 5-year term, right? It's $250,000 mortgage. They want to go up to a $400,000 mortgage. We're going to blend the 250,000, their current mortgage amount, with their current rate, plus the new 150,000 at today's current rates. So it's the rates might go from 2.5 to, let's say, 3.6, but still it's going to be below. A, it's going to be no penalty. B, it's a much lower rate than what they're going to get right now. But if they're borrowing additional money, their rate will go up.
Mhm.
And what is bridging? What is bridging? I've heard this word, bridging.
Yeah, bridge finance. So we do a fair amount of bridges as well, right? So if you want to buy, if you want to buy your home, essentially before the home that you're buying, essentially the home that you're selling closes after, we're essentially giving a bridge loan. So we're almost lending the down payment, right? And then once your actual home sells, you pay us back through the equity of the sale, right? So essentially you don't have to close after. You can close a little bit before. So some clients just logistically it's a little bit easier. So you can close a week before. Bridge rates are pretty high. They're about 10.75%.
Okay.
So so if you're doing a large bridge, it can be pretty expensive over, let's say, a month or two. But if you're just doing a short bridge for a week, just so you can get your stuff moved in and make things logistically easier, it's not that bad.
That's great. Yeah, you're paying for convenience, basically, right? So it's an additional option, right? So that's good to know. Thanks.
And it saves us from closing on the same day, because sometimes that can be.
Exactly. So yeah, we do bridges all the time. The biggest qualification issue for a bridge for a client is the bank and any lender always wants to know that the client is fine if the sale falls through. So what we need on our side is the client to show they have access to 3 months principal, interest, taxes, and heat. Almost that GDS number I was telling you guys about earlier. But principal, interest, taxes, and heat, if that totals $2,500 a month for the client, we want to show they have $7,500 because that means they can make both payments, right? If the sale falls through, they can make both payments for 3 months, have time to relist their home and sell it, right? If that sale does fall through. So that's, I mean, and the clients don't need to have that in cash or investments. If they have a line of credit, for example, we can use that. They just need to have access. You can do a gift for that if you want. They just somehow need to have access on a worst case scenario if they don't have that 3 months. Okay. Perfect.
So slightly off question here. You
Yeah.
guys are the only ones that do vacant land without the intent of building, correct?
Correct. Yeah. As
And
far
then
as,
what's,
far as I know, because there's some lenders that will do it that you have to build within a year. For us, you know what I mean, you could hold it for 5 years, 10 years if you want, right?
And what's-
there's no.
what's the percentage down on that?
So it all depends. I mean, the policy states for us 35% down payment on that. I've had it done as good as 20% down. Now the big thing that depends on is 2 items. It's A, the strength of the borrower, and B, the location of the lot of land.
Okay.
Right, so is it a readily marketable piece of land in HRM or surrounding? Or is it a rural lot that's 30 or 40 grand well outside Halifax? And if the client's debt servicing is tight, they're gonna do 35% down. So if we have a $150,000 lot, I can usually push that to 80%. Yeah. So it's kind of client by client basis.
Okay, great. Thank you.
No problem. And then so a lot of times just to go back to that land piece, we're one of the only lenders that will do construction draw mortgages as well. Because normally you won't see a turnkey build if the client already owns that piece of land. So if they're doing that land, if they're buying that land, chances are they do want to build or have intent to build at some point. So that 35% down that they put on that land, or 20% down, depending on the client, that's going to go towards the down payment of the whole overall project. You know what I mean? So that equity there. So if they're buying $100,000 lot of land, they're putting 35,000 down. So we have $35,000 of equity there. If they want to build within 6 months of that or a year of that, that's part of their overall down payment, right? So depending on how much they want to do for the build, they may not have to inject any more cash in because that cash that they put in for the down payment covers the down payment potentially for the whole project.
Oh, great. Yeah.
Yeah. Any other questions at all I can help you guys with? We're good. Perfect. Well, I appreciate everybody hopping on. I know things are very, very busy right now. So taking the time, I know it's an important discussion that we need to have about rate. And I just want to have it because there's so many clients that are asking me about it. Realtors asking me. So I just want to kind of put some key points out there. But please reach out and I can kind of talk about this offline a little bit further if you like. And
Just one more question, Mike.
Sure, Vic.
In your opinion,
Yeah.
would you think it's still smart to take a variable or is it more like buyer risk, right? Like some people may not be as comfortable, but there is such a spread, right?
It's such a large spread right now, I can say it this way. If I was to buy a home tomorrow, I'd be doing variable personally.
Mhm.
Just the spread's almost 2 points, right? It's so large that even if, our economist says it's going to be 175 points, even if it goes up 175 points, you're still going to be sub 5%, right? Because if you have rate now, remember prime's 3.7. If you take,
Yep.
let's say points off that, you're going to be 3% as of today. You go up 175 points, you're going to be 4.75%. You're still 30 to 40 points below where the 5-year fixed is right now, right?
Okay.
Other advantages with variable, you can pay it off at any point. Your penalty is only going to be 3 months interest, so a much smaller interest back bank if you choose variable versus fixed. You can increase your payments by 20%, 20% lump sums per year. Flip it to a fixed whenever you want. There's a lot of advantages there, but big thing being the rate. Just given that large spread right now, I would personally go variable. Some clients would be like, some clients will say, "Well, Mike, I just don't want my payment to go up." But if you go back to what I originally told you about variable, for us, your payment doesn't go up. So if you sign on the dotted line and the payment's $1,750 per month, that's going to stay $1,750 per month even when rates go up. Remember, it's just gonna take your amortization out slightly. So if you start at 20 years, you might go to 23 or 24 years, right?
Mhm.
So you have the power yourself to increase that payment if you want. You might be like, no, I want my payments, or I want my amortization to stay 20 years. I'm gonna retire in 20 years. I just want everything around 20 years. Then just let your clients will reach out to me and I'll say, okay, bump your payments up from 1750 to 1861, whatever that number is. I'll figure that out exactly for them. But if they want their amortization to stay whole, then I'll do that. Kind of crunch the numbers for them.
Yep.
Do that. Yep.
That's great.
Yeah.
Yeah.
Thank you very, very much.
Well, perfect. Thanks, guys. I really appreciate you guys coming on. I know time's valuable. So if you have any questions at all, please reach out to me. So Maureen,